Hi there, tax accountants. I hope all is well, and I pray that as you're viewing this video, that you're in the best of health and spirit. This video will cover several questions from Chapter 7, which deals with corporations and reorganizations. So we'll jump right into this first question. For this question, it says, for each reorganization, provide the letter of its most likely type. So, as we learned in Chapter 7, a tax law specifies 7 corporate restructurings or reorganizations that will qualify as non-taxable exchanges, similar to Section 1031. If you've never heard of it, Section 1031 is a provision in a tax law that essentially allows you to defer, and defer basically means to postpone or to delay recognizing the gain when you transfer one piece of real estate for another. Obviously, there are some requirements that need to be met. Likewise, with the reorganizations, there are some requirements that must be met. And if a transaction fails to qualify as a reorganization, then obviously it's not going to receive the special tax favor treatment. And each type of reorganization has specific requirements that qualify the transaction for the benefit of the deferred income recognition. So here we see example, the acquisition by one corporation of another in a stock for stock exchange. So we have a recapitalization. So for recapitalization, this falls under the type E. So type E, that type of reorganization is a recapitalization. This is where there's a major change in the character, as well as the amount of outstanding capital stock, securities, paid in capital of a corporation. So the transaction is significant only for the stock or bondholders who are going to exchange their equity or securities. B states a transfer by a corporation of all or part of its assets because of a bankruptcy. So this was legislation introduced by Congress. So this is a type G reorganization. And in this acquisitive type G restructuring, substantially all of the debtor corporation's assets are transferred to an acquiring corporation in exchange for its stock and securities, and the stock and securities, they're distributed to the senior creditors in exchange for their claims against the debtor. C, a consolidation. So a consolidation, this would fall under type A. So under type A, this is where there's a reorganization that can be classified as either a merger where two companies are coming together, or a consolidation whereby one of the companies cease to exist and the other continues to exist. So a merger, that's basically, again, a union of two or more corporations with one of the corporations retaining their existence and absorbing the other, so the other is no longer to exist. A consolidation happens where they create a brand new corporation to take the place of two or more corporations. So definitely important to distinguish between a merger and a corporation. Next, we have a spinoff. The spinoff would fall in line with type D. So a type D reorganization is a bit different. So generally it's used for a corporate division. This is generally called a divisive reorganization. And in contrast with the other restructurings, the entity that's transferring assets in a type D reorganization, they're considered the acquiring corporation, and the corporation receiving the property is the target. Next, we have E, which is a acquisition by a corporation of another in stock for asset exchange. This would fall under type C. So in a type C reorganization, the acquiring corporation, they'll obtain substantially all of the target's assets in exchange for acquiring the voting stock, in addition to a limited amount of property. The target company, however, they need to distribute all of their assets received in the reorganization, as well as any of its own property retained, and then effectively the target will need to liquidate. Lastly, we have a change in the state of incorporation from Nevada to Delaware. So in such case where there's a change of such nature, this is considered type F reorganization. So with a type F reorganization, what essentially happens is that there's a mere change in identity, maybe the form, the place of organization, however affected. So because of the type F reorganization, it involves only a slight change. The successor is the same corporation as its predecessor. So this would be a type F. All right, so again, we have types A, B, C, D, F, all the way through G. And ultimately, that's why great tax planning is going to be necessary whenever a company is deciding to reorganize. So we move on to the next question, and this question states, complete the following statement regarding why a private letter ruling from the IRS is like an insurance policy for a corporate reorganization. So whenever feasible, parties that are, considering a corporate reorganization, they should obtain a letter ruling from the IRS. So as we saw previously, there's, 7 different restructurings, reorganizations, and there's a lot of nuance to each of them. There are different requirements, there are various advantages and disadvantages. So careful reorganization planning, it can help to reduce or totally eliminate the possible current taxes for both the corporation as well as the shareholder. So consequently, whenever it is feasible, it is strongly recommended to obtain a letter ruling from the IRS to determine what the potential income tax effect of the transactions would be. All right. And essentially assuming that the parties, they proceed with the transactions as proposed, as outlined in the ruling request, then obviously a favorable ruling provides in effect an insurance policy as to the treatment of the restructuring. So here we see requesting a letter ruling from the IRS about a reorganization will provide the parties involved with information regarding not the legal effect. We want to know, are we going to owe Uncle Sam anything? And this is on behalf of the corporation and the shareholder. So the income tax effect of the proposed transactions, if the parties proceed with the transaction as proposed in the ruling request, a favorable ruling indicates the legal treatment by the courts, tax treatment by the IRS. Correct. So the key thing is the corporation wants to know, as well as the shareholders, what is going to be the impact if we restructure, we reorganize. And again, it's like an insurance policy. It basically lets the corporation and the shareholders know in advance what the potential implications would be, if any. All right, so this brings us to our next question. Here in this question, it asks us to complete the statements below regarding how the 4-column template summary, the 4-column template in concept summary 7.1 is used to determine a shareholder's basis in the stock received in a corporate restructuring. All right, so I have a rendering, or we can actually open it as well. All right, so here we have the concept summary 7.1. All right, so this is a gain in basis rules for non-taxable exchanges. So as we know, as mentioned earlier, the tax treatment for parties involved in a tax-free reorganization, it's almost exactly similar to Section 1031. As mentioned, you have a piece of real estate, you transfer it for another piece of real estate, then you get to defer the income, postpone, you delay recognizing the income. So in this example, again, in its simplest tax-free reorganization, there's neither a gain nor loss that's going to be recognized when there's an exchange for stock unless they receive boot in addition to stock. Boot, similar to Section 351, this is any other asset that's received other than stock or securities that's exchanged in the reorganization. So whenever boot is received, gain but not losses are recognized. So with this 4-column template concept summary 7.1, which we have on the screen, this essentially computes the amount of gain recognized as well as the adjusted basis in a new asset received in the non-taxable exchange. The cash or other property is going to be considered boot, and the gain that's recognized by the stockholder is going to be the lesser of the boot received or the gain realized. And that gives us our recognized gain. So when you see the word recognized gain, that essentially denotes the amount that is going to be reported for tax purposes. All right. So this is analogous to the treatment of boot in a like kind exchange. So the only instance where shareholders are going to recognize losses in reorganizations, this is when they receive boot and no stock. So using the 4-column template, as we see in the summary, the shareholders' basis in a new stock is the fair market value of the stock received, less the postponed gain, which was calculated in column 3, or the postponed loss, which was calculated in column 3, and that would give us the basis in the new asset. So this computation, it basically helps to ensure that the gain not currently recognized is going to be recognized when a stock is sold at a later date. So fairly similar to section 351. So to answer this question, the shareholders' basis in a new stock, as we just read, it's not the carryover value, but it is the fair market value of the new stock less the postponed gain or plus the postponed loss. The blank gain is equal to the gain that was blank. So the postponed gain is essentially going to be equal to the gain that was realized, because again, a gain could be realized. So to give you a quick example, let's say I have a piece of property and I purchased the property for $100,000 and the fair market value of the property is now $150,000. The property has appreciated. What that means is that the value of the property is more than what I paid for it. So it's a realized gain. If I do not sell the property, there's nothing I need to report for tax purposes. So that's the key distinction between realized gain. Yes, there's an appreciated value, but the recognized gain, that denotes how much is going to be reported for tax purposes. So the postponed gain is equal to the gain that was realized, but not recognized. The computation ensures that the gain not currently recognized will be recognized when a stock is sold at a later date. All right. So with these rules, again, let's say the value, well, we'll keep the same numbers, 100,000 is now valued at 150,000. I defer the gain of $50,000, but what will happen is that now when I sell it, that $50,000 gain that was not recognized previously, that was deferred, when I sell the stock, that $50,000 postponed gain is now going to be recognized, because again, Uncle Sam don't play that. And he wants to make sure that individuals are not taking advantage of these provisions to receive favored tax treatment, because there's a lot of savvy ways to circumvent and to utilize the tax laws in your favor, but they have it very clearly shown here with the basis of the new asset. What's the fair market value of the stock received? You subtract the postponed gain or you add the postponed loss, and that is how you're going to determine the basis in a new asset. So it's pretty straightforward. All right, so we move on to our next question. This states, complete the following statements regarding Type B reorganizations and the relationship between the corporations participating in the restructuring. So we are looking at a Type B reorganization. So as we know, there's 7 reorganizations authorized by the code. Each of them has specific requirements. They have advantages, they have its disadvantages. So this question in particular, we are focusing on Type B. So in a Type B reorganization, the acquiring corporation obtains at least, so one of the key things with a Type B, control is considered 80% of the target corporation in exchange for what? So in summary, the Type B reorganization, again, the acquiring corporation, they obtain at least 80% control of the target corporation in exchange involving solely stock. That's one of the key things. So solely stock, and not just any stock, but it's solely voting stock. And they're stock for the voting and non-voting stock of the target. So with this Type B, not just all classes of stock, not just non-voting stock, but the voting stock must be the sole consideration given by the acquiring corporation. And this is a requirement. Is it loosely, strictly, uniquely? It is strictly construed. And after the restructuring, from there, a parent subsidiary relationship is developed. So if the surviving corporation with the target absorption, this would be like a merger. And if there's a surviving corporation, this falls into the other types of restructuring. So a parent subsidiary relationship. So we'll go over it again. In a type B reorganization, the acquiring corporation obtains at least 80% control of the target corporation in an exchange involving solely its voting stock for the voting and non-voting stock of the target. The voting stock must be the sole consideration given by the acquiring corporation, and this is a requirement that is strictly construed, and after the restructuring, a parent-subsidiary relationship is created. All right, this brings us to our next question. So here it states, complete the following statements that briefly describe the judicial doctrines of sound business purpose, continuity of business enterprise, and the step transaction doctrine. All right, so besides the statutory requirements for reorganizations, there's several judicially created doctrines that have become basic requirements for tax-free treatment. And these doctrines, they include the sound business purpose, continuity of interest, and continuity of business enterprise doctrines. So the courts, they formulated the step transaction doctrine to help determine the tax status of a reorganization that occurs through a series of related transactions. In addition, a reorganization plan that's consistent with one of the code reorganizations, it is required. So the blank prevents taxpayers from engaging in a series of transactions for purpose of obtaining tax benefits that otherwise would not be allowed if the transaction were accomplished in a single step. This is the step transaction doctrine. Next, it states the blank requires the acquiring corporation to either continue the target corporation's historic business or use a significant portion of the target corporation's assets in its business. This would be the continuity of business enterprise. Next, we see the blank requires that the reorganization have economic consequences germane to the business. This is the sound business purpose. So again, these are the key things. In addition to the statutory requirements, there are some judicially created doctrines rather, that are also some basic requirements. All right, this brings us to our next question. So here it states, what is Rebecca's realized and recognized gain or loss from the reorganization? The exchange of Rebecca's stock, blank income tax consequences for Gotcha or Solus, and what is Rebecca's basis in her Solus stock? All right, so with this one, we have an Excel. Pull it up so we can go through both. All right. So here we see it's asking us, for example, 715, and as mentioned, we know that the tax treatment for parties involved in a tax-free reorganization, they almost parallel the treatment under a like-kind exchange provision of Section 1031. In its simplest kind exchange, neither gain nor loss is going to be recognized. Corporations that meet the 368 requirements, they do not recognize the gain or losses on restructurings. However, there's an exception to a non-recognition rule when other property is transferred by the acquiring corporation. Other property, also called boot. If boot is transferred, gain but not loss is going to be recognized. And again, generally the shareholders of the corporations involved in a tax reorganization, they won't recognize gain or loss when exchanging their stock unless the stock they receive, or unless they receive boot rather, in addition to the stock. So we see Rebecca holds smaller, perfect. So we see Rebecca holds 100 shares of Gotcha stock that she purchased for $1,000 several years ago. In a merger of Gotchas into Solus, Rebecca exchanges her 100 Gotcha shares for 1,000 Solus shares and 500. So she received stock in addition to $1,000. Gotchas is valued at $40 per share and Solus at $3.50 per share. So the first thing we need to determine is, well, what is the value of the stock, right? So in this case, the Gotcha share, the price per share is $40. How many shares did she receive? 1,000. So therefore, the stock value is the price per share multiplied by the number of shares, 1,000. Sorry, 100 shares. All right. So Rebecca exchanges her 100 Gotcha shares for the Solus shares. So the Gotcha shares are $40. So 100 shares times $40 a share. So 40 times 100. The stock value is 4,000. All right. Next, we need to determine how much she received. So in such case, the shares she received was 1,000 shares. So it said 100 shares, but she received 1,000 shares of Gotchas. So she received 1,000 shares of Gotchas. What I'll do, I'll update this. Gotchas shares, and then this would be Solus shares. All right, just so we can, distinguish. So we have the Gotcha shares and the Solus shares. So for the Solus shares, she received 1,000 shares of Solus, and the price for the Solus is $3.50 per share. And we're going to keep it at $3.50, no rounding. Plus the boot received, in this case, it lets us know she also received 500. So therefore, the total amount realized is the 1,000 times price per share of $3.50 plus the $500 cash she received for a total of 4,000. So therefore, the amount Rebecca received in this case was 4,000. And it lets us know here that her basis in the Gotcha stock was 1,000. So we subtract her basis, we get the sum. So she received 4,000. Again, the 1,000 shares of Solus times $3.50 per share gives us 3,500, plus the boot, the cash received of 500. So the amount received less the basis, which was given, there's a realized gain of 3,000, right? But again, according to concept 7.1, we need to determine what is going to be the recognized gain. And the recognized gain is going to be the lesser of boot received, which in this case is 5,000, or the gain realized. So, I know we know how to do the math, the difference between the 500 versus the 3,000. The recognized gain in this case is going to be $500. It is the lesser of the two. So now we move on to column 3. So for column 3, it asks us, what is the realized gain or loss that we calculated in column 1? So that was 3,000. And from there, we need to subtract the recognized gain from column 2. And in column 2, we calculated $500. So therefore, next thing we need to do, I'm gonna make these a little smaller. So now the next thing that we need to do is to factor in the postponed gain or loss. So in such case, the realized gain was 3,000. We recognize 500, which was the lesser of the Buddha received gain. So therefore, our postponed gain is 2,500. All right. So now we move on to part 4. In part 4, well, what is the basis in the solar stock, right? So the basis in the solar stock is as follows: 1,000 shares, and each share is worth $3.50. So 3,500. From there, we subtract the postponed gain as calculated in column 3. So we subtract the postponed gain. So therefore, the basis in the stock is $1,000. All right. So based on this information, the exchange of Rebecca's stock has no income tax consequences to Gotchas or Solis, right? Because again, we know generally the shareholders of corporations, they do not recognize gain or loss unless boot is received. So Rebecca has to account for the gain, the lesser of the boot or gain realized, so that $500, but it's asking for Gotchas or Solis, which is the corporations. And it's asking, what is Rebecca's basis in her solar stock? We calculated the information, and therefore the basis in the stock is going to be $1,000. So again, for this problem, we utilize the concept summary from 7.1, the gain and basis rules for non-taxable exchanges. We start off with determining the realized gain or loss. We calculated the amount received as follows. The amount received was essentially based on the shares received in the new stock multiplied by the price per share plus the cash received, and that gave us the amount realized. So I'll put it in another color so we can clearly distinguish it. All right. And then from there, we needed to determine the recognized gain, and based on the rules, it's the lesser of boot received or gain realized. And then from there, we were able to calculate the postponed gain or loss and the basis of the new asset. So this brings us to our next question. All right. And so for this question, it asks us, what is Cato's recognized gain or loss from the reorganization? And B, what is Firestar's gain or loss from the reorganization? So it states, in a qualifying reorganization, Cato Corporation exchanges $1,200,000 worth of stock and property valued at $500,000 with a $245,000 basis for all of Firestar Corporation's assets, which have a value of $1.7 million and a $500,000 basis. Firestar distributes the property received from Cato. The exchange meets all the code's requirements. So we ultimately need to determine now, well, how much is going to be recognized, if any. So we see that it wasn't just stock, it was also property. So since boot, property is being used in the transfer, Cato is going to need to recognize a gain on the reorganization. So what is the fair market value of the property? The fair market value of the property is $500,000. The basis in the property which is given is $245,000. In such case, there is going to be a recognized gain as follows. The fair market value less the basis. Therefore, Cato is going to need to recognize a gain of $255,000. The corporation, on the other hand, they meet the Section 368 requirements. They're not going to recognize the gain or the loss. So since Firestar distributes the property received from Cato, in such case, they are not going to recognize a gain. So they'll recognize no gain or loss of $0. But keep in mind, if Firestar decided to keep the property, they would have to recognize a gain to the extent of the other property received, which was $500,000. But again, in this case, they distributed all of the property, and because they did such, none of it is going to cause them to have to recognize a gain or loss from the reorganization. All right, so this brings us to the next problem. So here it's asking us to complete a letter to Miss White outlining the requirements for a Type C reorganization as well as our analysis. So it states, Etta Corporation approaches Lily White, the CEO and sole shareholder of Muco, regarding the acquisition of Muco's cat toy division assets worth $1.3 million. Because selling the assets would create a $600,000 gain, Lily declines the offer. Eder counters and suggests a Type C reorganization as a method of acquiring all of Muco by exchanging its voting stock for all assets now worth $1.5 million and all liabilities $650,000 of Muco. The other division of Muco, Cat Publications, is small, with assets worth $200,000 and liabilities of $150,000. Lily agrees to the reorganization if Muco receives the net value of the Cat Publication division, $50,000 in cash, because Lily would like to receive money as well as stock. Lily requests your advice on whether the transaction can be structured as a Type C reorganization as it is currently described, and if it cannot meet the Type C requirements, suggest an alternative plan that will allow the transaction to qualify as a Type C reorganization. So it asks us to complete the letter to Ms. White outlining the requirements for a Type C reorganization as well as your analysis. So when we're dealing with a Type C reorganization, the acquiring corporation, they obtain substantially all of the target corporation's assets in exchange for the voting stock and a limited amount of property. So after which the target, they need to distribute all of the assets that are received in the reorganization as well as any of its property retained. From there, the target is going to liquidate. So in a Type C reorganization, it's essentially a voting stock for assets exchange followed by a liquidation of the target. So in order to receive a favorable IRS ruling, the target, they need to transfer at least 90% of the net asset value and 70% of the gross asset value to the acquiring corporation. After which the target corporation, they're going to need to distribute all of the assets that it receives as well as any of its own property. The exchange in a taxable transaction for the shareholders to the extent that they receive assets other than the acquiring stock, right? And again, the acquiring corporation consideration in a Type C reorganization, normally it'll consist of the voting stock. So here we see this letter from Swift LLP, dated November 19, 2024. So it's saying, Dear Ms. White, I am responding to your question as to how to arrange the acquisition of Muco by Etta Corporation and to have it qualify for tax favored treatment. We believe that the transaction as it is currently structured, it will not qualify as tax favorable, Type C reorganization. Our conclusions are based on the following facts. Muco has gross assets valued at $1.5 million, right? And how do we determine that? We determine it based on the toy cats divisions, which is worth $1.3 million. And then they also have the cat publication, their assets are worth 200,000. So 1.3 million plus 200,000. That is how we calculate the gross assets valued at 1.5 million. And it says they have a net value of 850,000. Right? How do we determine that? We scroll up. We see the value of the toys, which is worth 800,000 for toys. And then we see the value of 50,000. So here we see the difference between the cat publications, the 200,000 minus the 150, which gives us the $50,000. And then from there, we also have to factor in the $800,000 values of the toys, which is the appreciation or the basis rather. So in such case, and it says the Muco liabilities amount to $650 and Muco is requesting a receipt of $50,000 cash. So as we mentioned earlier, for Type C reorganization, at least not 20, not 50, but 80% of the fair market value of Muco's assets must be obtained by ETA with voting stock. Assumption of liabilities is considered other property if any cash rather received by Muco. So since Muco is receiving $50,000 in cash, the $650,000 of liability plus the cash, this causes only $800,000 of the assets to be acquired by ETA with its voting stock. So therefore, based on this, the percentage acquired, the voting stock, it's only about 53%, right? And how do we determine that? We get our calculator. 800,000 represents how much they are going to acquire. Divided by the gross value, the fair market value of the assets of 1.5 million. So the percentage acquired with the voting stock is only about 53%. So therefore, this is obviously not going to meet the percentage requirement. In the event that, let's say, if Muco were to retain the publications division and then sell it to receive the $50,000, in such case, the transaction would qualify as a Type C reorganization. And we know that a Type C reorganization requires that substantially all of the assets of Muco be transferred to ETA. And although there's essentially no definition of substantially all in the Internal Revenue Code, the IRS requires at least 90% of the assets net value. And as we mentioned before, 70% of the gross value to be transferred. So therefore, the suggested transaction will meet these guidelines, because if we consider the toy division's net value, it's more than the 90% requirement, and the gross value is more than the 70% requirement. So therefore, if ETA exchanges its voting stock for the toy division, Muco sells the publications division. Muco distributes the cash and ETA stock to Lilly, and then Muco will need to liquidate. The transactions will qualify as a Type C reorganization. All right. So I know that there's a lot going on in this problem, but the key thing again, under the Type C reorganization, they require that substantially all of the assets are transferred, and at least 90% of the assets net value and 70% of the gross value is going to be transferred. So the way that they originally intended to handle it, it didn't, line up. So therefore, if they decide again to retain the publication division and sell it, in such case, then there's a possibility that they can meet the requirements for Type C. So this brings us to our next question. And in this question, it asks, can Rowe use a Type E reorganization? Assuming face value of the bonds does not change, is the exchange of 3% bonds for 5% bonds taxable? If the exchange of common stock for preferred stock occurs before the acquisition of Sheen, we want to determine how many shares they're going to receive and what's the value. And if the purchase of common stock, if it's going to be a taxable event, and how many shares they will need to purchase to have a 25% rather interest. So it states the Rowe Corporation was incorporated 8 years ago by Tai and Danette. Tai received 5,000 shares of common stock for his $100,000 contribution, and Danette received 10,000 shares of common stock for her $200,000 contribution. 5 years ago, both Tai and Danette acquired $50,000 of Rowe bonds paying 3% interest. In the current year, Rowe's common stock is valued at $900,000. Sheen Co. would like to acquire a 25% interest in Rowe by purchasing common stock from Rowe. Tai and Danette see this as a good time to restructure Rowe's capital. They would like to own bonds by paying 5% interest instead of 3%, and each would like to receive $120,000 of preferred stock. with a par value of 100 per share in exchange for some of their common stock. So as we know, Section 368 specifies 7 corporate restructurings of reorganization. In this case, it's talking about a type E. So type E reorganization, this is recapitalization, and this is when there's a major change in the character, the amount of the outstanding capital stock, securities, or paid in capital of a corporation. So the transaction is significant only for the stock of bondholders who exchange their equity or securities. So since no property, stocks, or bonds are exchanged with another corporation, the Type E reorganization, there's no current income tax implications for the corporations that are involved. Further, any transactions in the corporation's own stock or bonds, these are also not considered taxable events. So in this case, this Rowe can use the type E reorganization to accomplish its restructuring. So the correct answer would be yes. We move on to B. Assuming that the face value of the bonds does not change, is the exchange of 3% bonds for 5% bonds taxable? So as we mentioned, an exchange of bonds for bonds is not taxable so long as the face value of the bonds don't change. And the fact that the interest to be received is going to increase, it doesn't create income until the higher interest is paid. So therefore, the correct answer for this is going to be no. C, if the exchange of common stock for preferred stock occurs before the acquisition of Sheen Co., Tayi and Danette will each receive blank shares of preferred stock. So for this question, we have an Excel. So in order for us to answer question C, all right, we need to consider, well, what's the value of the common stock? We want to determine what is the per share price. So the common stock here lets us know that it's valued at 900,000. So we have the 900,000 in our numerator, 900,000. And we need to determine the shares outstanding. So based on the problem, there's 15,000 shares outstanding. How did we determine that? Tayi received 5,000 shares and Danette received 10,000 shares. So we add the two, 5,000 plus 10,000. That gives us 15,000 shares outstanding. So therefore, the price per share is the 900,000 divided by the shares outstanding. So therefore, the price per share is $60. I'll make this green, yellow, since we're going to use this again. All right. So now, based on this problem, we'll scroll down. So again, we want to determine how much, are they going to receive? All right, so how much they're going to receive. So in such case, how many shares? The next thing we need to factor in is if they are going to be receiving $120,000. So we see it here, the preferred stock price is $120,000 and the price per share is 60. So 120,000 divided by 60. This lets us know that if they essentially decided to, exchange it for the common stock, then in such case, it is going to be based on $2,000 because the preferred stock price versus the price per share. So for the first part of the problem, if they exchange a common stock for preferred stock, and if it happens before, they're each going to receive 1,200 shares. So they will receive 1,200 shares of preferred stock. How do we determine that? Because the par value of the preferred shares is $100. So here it says they want to receive $120,000 worth of preferred stock. So I'll get my calculator so you can see the math. All right. So again, they want to receive 120,000. So it would be 120,000 divided by $100 per share. In such case, they would receive 1,200 shares. 1,200 shares of preferred stock valued at 120,000 in exchange. And again, 120,000, which represents the preferred stock price divided by the price per share for the common shares in exchange for 2,000 shares of common stock. All right. So now we move on to part D. And part D asks, is the purchase of common stock by Sheen Co. a taxable event? As we mentioned, no, it is not going to be a taxable event. But now it asks, how many shares of common stock will they need to purchase in order to have a 25% interest in Rio? Right? So we know that the old common stock value is 900,000. And we essentially want to own 25% of the corporation. So therefore, based on this information, it's kind of like we're going to have to, work backwards with the formula to determine how much shares they would need to purchase in order to have 25% ownership. So in such case, get a zero, so 900,000. So we know that the price per share is $60. And we want to ensure that the total common stock owned, that we would own at least 25%. So the formula would essentially be like this. 900,000 plus X equals 25% of Y or something like that, right? So to make it easier, the shares purchased in this case would be 5,000. And what's a way for us to determine this? So 900,000, let's say maybe we've been, made it something else. Let me make this into. So just to give you guys, insight. So let's say the net common stock value. So let's say they purchased 3,000 shares and we know that the cost of the shares. So we're going to look at two scenarios. Let's stick with 5,000. So 5,000 shares. So 5,000 shares times 60%. So the value of the old common stock is 900,000. And the value of the new common stock is 300,000. So we add the two. That gives us total common stock owned of 1.2 million. So in such case, 1.2 million multiplied by 25% gives us 300,000. So therefore, 300,000 divided by the price per share of 60, that lets us know that they would need to purchase 5,000 shares. All right. So in such case, they will need to purchase 5,000 shares. So it's kind of like algebra. You're kind of going to have to, back into the amount. But the key thing is that they want to ensure that they own 25% of the shares, to have 25% rather interest in the corporation. All right. So this brings us to our next problem. Here it states to classify the following as yes, a tax issue, or no, not a federal income tax issue regarding these transactions. It states Aqua Corporation is a retail operation specializing in pool equipment and outdoor furniture. It is interested in merging with Icterine Corporation, A lamp manufacturer, Aqua is very profitable, and Icterine has a large net operating loss that it has not been able to utilize. Aqua proposes to exchange about 40% of its stock and 200,000 for most of Icterine's assets. The assets not acquired by Aqua will be distributed to Icterine's shareholders. Aqua stock will be distributed to most of Icterine's shareholders, while dissenting Icterine's shareholders will receive cash. Aqua is not interested in the lamp business except for the possibility of making pool lights. It therefore will sell off Icterine's assets except those that can be retooled to manufacture these items. So we have to choose yes or no. A, does Aqua have a sound non-tax business reason for the proposed merger? So based on this, even though the statutory requirements are literally followed, again, there's some judicial things that need to be met. So yes, this is a tax issue. B, the acquiring corporation's shareholders must receive an equity interest in the target corporation. So the answer for B is no. So to qualify for tax-favored status, the target corporation shareholders must receive an equity interest in the acquiring corporation, not the target. C, after the reorganization, would the continuity of business enterprise test be met? Yes, this is important. Specifically, the business enterprise test, this requires that the acquiring corporation either, one, continue the target's historic business test, or two, use a significant portion of the target assets in the business. D, are the dissenting shareholders a large enough group to prevent approval of the merger? So one of the key things under the continuity of interest test, target shareholders receiving stock that is at least 40% of their prior stock ownership. Not all target shareholders need to receive stock. And in the surviving corporation, the requirement is applied to the aggregate consideration given by the acquiring corporation. E, should Aqua evaluate Icterine for contingent liabilities? Yes, this is a big deal because a reorganization, it must result in some continuation of the previous corporation business activities. Existing liabilities are rarely liquidated, and an exception would be type G. F, will the continuity of ownership interest requirement be met for Icterine? In such case, yes, this is going to be important. And G, if NOL carryovers are available, are they restricted to Section 382? So to curtail the tax benefits received from the NOL, Section 382 limits the yearly NOL that's going to be utilized by the successor corporation. So this answer is yes. All right, so this brings us to our last question. And here it asks, if the shareholders use a 5% discount rate, should this offer be accepted? The present value factor for 5 years is at 5%, 0.7835. So it states, through a special Type C reorganization, Springer Corporation was merged into Spaniel Corporation last year. Springer shareholders received 40% of the Spaniel stock in exchange for all of their Springer shares. Springer liquidated immediately after the exchange. At the time of the merger, Springer was worth $2 million. The Springer shareholders are promised that Spaniel will purchase $3 million of all their stock 5 years after the reorganization. So again, as we know, when we're dealing with Type C, this is basically where the acquiring corporation obtains substantially all of the target's assets in exchange for acquiring voting stock and a limited amount of other property. So the Spaniel stock, I'm going to get my calculator ready. The Spaniel stock owned by the former Springer shareholders is worth $2 million, as we see here. The present value of receiving $3 million, in order to determine using the discount rate, they already gave us, we didn't need to go to the present value table. They already gave us the information. So 3 million multiplied by 0.07835, that lets us know, oh, it's missing a zero. So 3 million multiplied by 0.07835. All right. So it's currently worth Oh, messing it up. My bad. 3 million times 0.7835. There we go. So, in such case, to answer this question, if the shareholders use a 5% discount rate, should it be offered? The answer is yes, because the value of it is $2,350,500, which is greater than the value, because the value we see is 2 million, and we see that the present value is 2,350,000. So how do we get that again? 3 million multiplied by the present rate, which is given 0.7835. So it's worth $2,350,500 when it is now worth 2 million. So therefore, yes, they should accept this offer. So this brings us to the end of chapter 7 homework questions, which covers corporations and the various techniques to reorganize and restructure.